Good morning, everyone. Thank you for joining our 14th Annual Investment Manager webinar. Thank you for taking time. We appreciate it. The investment manager community is an integral part of our ecosystem, so we really value and appreciate our relationship with you. So for today's webinar, we'll spend time on four main aspects. One, we'll give you a quick introduction on NEPC and our business. We'll then provide an outlook on allocators outlook and talk about the investment manager search activity that we've seen at NEPC over the last year. We will then dive into investment team setup at NEPC, basically talking about how we're structured as an investment group and how we do due diligence. And then lastly, we'll talk about some of the key initiatives at the firm that we are really excited about. So today, joining me will be Larissa Davy and Andrew Pettersen, both Senior Investment Director on our private markets team and based out of our brand new London office. And I'll be leading the discussion. My name is Dulari Pancholi. I'm a partner and head of credit and diversifying strategies based out of NEPC's Boston. So quick start on NEPC and a quick update on our business. As many of you know, NEPC is an independent investment consulting firm. We are headquartered in Boston, which is where I'm based. We have 8 regional offices and close to 357 employees. We are 100% employee owned with close to 50 partners. We have 7 distinct practice groups that includes private wealth, endowments and foundations, corporate DB/DC, pensions, insurance, Taft-Hartley. And we have close to 427 clients across both advisory as well as OCIO, and we have close to 1.6 trillion in assets under advisement. We invest heavily in both investments, research, and people, and our culture is extremely important to us. So next, we'll spend time on a broad market allocators outlook. And as many of you probably know, Greenwich Associates creates a survey of many institutional investors. And the main purpose of this is to understand some of the key considerations and challenges that allocators have in this space. So this slide lays out various considerations that allocators typically have in mind when they're making an allocation to your funds. The top 5 have consistently remained the same, as you can see on the left-hand side of the slide. Most of them are market volatility, asset allocation, rate of return and funding issues, inflation risk, and risk management. What we did see last year is a rise in a couple of newer considerations. One of them mainly is manager selection and liability management. The manager selection aspect is key because it affects you directly, and a big part of that rationale is given the increased anticipated wall in the market and dispersion in returns across both funds, managers, and opportunities in the space. This has become an increased consideration for a lot of allocators. This slide is where institutional allocators were asked to opine on where they see the tentative shifts over the next 3 years in their asset allocation. So we'll break this down in 3 big parts. One is equities, second is fixed income, and then we'll talk about alternatives. On the equity side, most allocators had almost a negative footprint. They're reducing allocations in the equities. And this is across the board on US, domestic, international, global, as well as EM. And the rationale for that is the risk premium or expected risk premium for equities is marginally lower than compared to bonds. And that kind of is where the shifts are coming from. On the fixed income side, the allocation is staying the same or marginally higher. But what is interesting to note here is the active US fixed income side is definitely on the rise. Allocators now have the luxury of de-risking their portfolio and upgrading the quality without losing a lot in returns given the higher interest rates, and that's reflected in what we're seeing as a movement away from EMD and global fixed income towards the domestic side. And finally, on the alternative side, which includes private equity, private debt, real estate, real assets, and hedge funds, we are seeing a huge ramp up in allocations, especially on the private equity side. And under this, we include growth equity, buyout, and venture. And a lot of these shifts can be attributed to allocators seeking increased risk compensation from complexity premium and liquidity premium. So this ties into the concerns around increased considerations for rate of return, market volatility, and inflation. This slide shows how allocators are thinking about ESG and DEI considerations. So this still remains a pretty sizable consideration when allocators are making funding decisions. And within ESG, it is mostly thinking about ESG integration, and within DEI, it's the DEI considerations both across at the firm level as well as the investment team. And at NEPC, we have included both these considerations into our manager rating process. So we have a separate ESG integration rating as well as DEI rating. So every idea that we underwrite will have a separate score assigned for managers' capability on ESG integration and the overall firm and investment team's diversity capabilities. So over the next couple of slides, we'll talk about what we've seen at NEPC and the search activity we've conducted within NEPC. So overall, this shows the various searches and portfolio reviews and placements we've conducted in 2023. We have done close to 687 searches and allocations, which is nearly 32 billion in assets, and split across different asset classes, as you see on the left-hand side of this slide. On the equity side, a big driver in searches has been focused on the international equity and EM equity, where there was the most compensation that clients could get for their risk assumed. On the fixed income side, it was mostly on the higher grade. As I mentioned before, allocators now have, given the higher rates for longer, allocators have this luxury of de-risking and moving into higher quality fixed income as they improve their sources of liquidity. On the alternative side, a big chunk of search activity was restricted to private equity and private debt. And that, when you think about how to think in context of searches, this is mostly slightly different. It is not a search per se, but it's also as clients have ramped up their allocation, and this includes the placements they've done over the year. One other things that we noted was the hedge fund activity. Over the last few years, while the hedge funds had lost ground in terms of allocation, last year we did see a little bit of a ramp up in allocation and portfolio reviews in that space. This is just a historical perspective of where we've seen allocation over the last few years. The top bars talk about the assets that have been placed across these searches, and the bottom is the number of searches. Again, the number of searches in alternative space have been on the rise over the last few years. So with that, I'm going to spend a few slides, which is probably the most important from your angle, how to interact with NEPC, how we are set up, and what is our process. So we'll first kick it off with how are we structured on the investment team side. I'll split this discussion in two main slides. One is broadly, how is NEPC's investment team structured? We have 5 main groups, all directed under our Chief Investment Officer, Tim McCusker. We have close to 69 professionals that are split across these 5 big groups, which are asset allocation, portfolio construction, investment strategy team, which is where the bulk of our investment due diligence team are housed, the OCIO group, and finally the research operations team. When we look through how the investment due diligence teams are structured, which is where you interact with us on most, we have two main groups. One is the marketable securities team that you see on the left-hand side, and the private markets team that you see on the right-hand side. All these groups are chaired by our team leader, Sarah Samuels, and we have 5 partners who are now heading the 5 various teams. So Will Ford, as you see on the left-hand side, is a partner at the firm, and he leads our equities group. And it's important to know here that the marketable securities team looks at both long-only as well as hedge fund strategies and any niche strategies that fall between private and public strategies. I lead our fixed income and diversifying strategies team. On the private market side, Josh Beers leads our private equity group, which consists of growth equity, buyouts, and venture. Oliver Fadley leads our private debt group, and Matt Ritter leads our real estate and real estate. I would want everybody to know that we are so excited to have Oliver join the partnership earlier in the year. So if you speak to him, please congratulate him on this fantastic achievement. We are very lucky to have him. And finally, the operational due diligence team at the bottom of the page that supports all the investment groups that you see on top. It's headed by Kevin Lohansen, and he's supported by 2 other investment professionals. So digging into our investment due diligence process, we have a pretty standard and a disciplined due diligence process that is consistent across both marketable securities as well as private markets. And it has the main pillars here I'm going to talk about. One is, how do we source ideas? We source from a number of proprietary databases, public databases, inbound inquiries from our clients. So there is a broad network of where we derive ideas from. The next 2 pillars are the kind of the crux of our framework in terms of how we look at an investment once we've narrowed down something. We start typically with a quantitative assessment. We will try to break apart the return stream of a product and try to assess how much is alpha versus beta. We'll try to figure out what is the investment edge. We'll look at metrics such as risk-adjusted relative to benchmark, to peers, drawdown frameworks from a risk management perspective. And most importantly, is this something that is sustainable? If it's a strong return stream, is it sustainable in the future? The next is the qualitative assessment. Once we like the return stream and it is something that we really want to pursue forward, the qualitative assessment is focused more on the firm resources, the team, the quality and the experience of the team, the alignment of interest, and the viability of the firm and the product. Once we have conviction based on these 3 pillars, we will bring an idea, we'll complete the due diligence, we'll include our ODD team, and we'll bring it to our due diligence committee, which is consisting of senior consulting members as well as members from our investment team and partners who are on the voting process. And finally, we spend a significant amount of time monitoring investment ideas and making sure we are in touch with managers that we've underwritten, we understand what's going on in the portfolio, and we can guide our clients accordingly. The result of all these process is rating a manager or a product, and we put it what we call our focus placement list, FPL for short, and that has 5 different types of ratings, starting with 1 through 5, 1 being our best idea and 5 being something that we would not recommend to our client. It's important to note that clients are still able to allocate to ideas that are rated 2 and 3 in addition to what is rated as 1. So this is a crux of the framework, investment framework that I spoke about, and we wanted to give a little bit more transparency in the pillar number 2 and 3, the quantitative and the qualitative assessment. The quantitative part, what we're trying to assess is how much is alpha, how much is beta, that ties into how much fees we're willing to pay or what we think should be charged. We're trying to assess what is the universe and whether the returns are in ballpark, what we should get from a relative comparison. And we're trying to assess how the returns are generated. Is it a one-time trade, or is it something consistently we can expect to be delivered in the future? On the qualitative assessment side, there are two main pillars. One is the investment process. We'll focus on the rigor and the discipline that you have internally for your processes. Who's making this decision? What is the alignment of those people? What's the quality and the experience of the team? How are they being retained? What is the risk management process in place? And what is the portfolio construction discipline that you follow? And the last is the alignment of not just the team, but also at the business level. What does your succession planning look like? How many products are you managing, and where is your priority in terms of the products that you are pitching to us as well as your clients? And this is a list of some of the attributes that we look at, the metrics that we think about when we rate a product. We won't walk through every line item in here, but we did want to give this for your reference. And this is a schematic of the rating that I just mentioned. On your right-hand side is our rating from 1 through 5, 1 being our best idea, 5 being something that we would not recommend to our client. In addition to our rating, we also have a parallel process for status change, and you can think about this as a sentiment change before we actually move something between the ratings on the product rating process. And finally, the fee discussion. You probably have heard from NEPC. We have a dedicated team that focuses on negotiating fees for what we think is appropriate or what we are seeing overall broadly in the marketplace. We use a lot of proprietary data tools and we build models to understand what is the break even and what is the best fee model for us, for our clients collectively, and also for the managers. We definitely want to make sure that that you have ability and capability to retain talent and infrastructure that we think you need to manage your business. Today, we are lucky that we have close to 460 investment products and firms that we have negotiated fees with successfully on behalf of our clients. So that concludes the bulk of our presentation from update on NEPC, transparency for NEPC's process, our investment team, and how we think allocators are looking to allocate in the future. So we'll spend time talking about a couple of key initiatives that we are excited about on our home front. One is our brand new Boston office. Today I'm working from home because we are starting from a new location next week on Monday. We're really excited about it. So if you're visiting our office, you should note the new location is 225 Franklin Street in Boston. This is about just a 5 minutes walk from our old office location. So we are excited to start in our new space. And we have a brand new London office, which I think is not brand new. We started late last year, last fall or autumn, as Larissa might say now. And so we'll hear from Larissa and Andrew on an update from our new London office. So with that, I'm going to hand it over to London team. Andrew's going to kick us off. Andrew, I'm happy to keep driving. Just let me know when.
Great. Thanks, Dulari. Thanks, everyone, for joining. Again, I'm Andrew Pettersen, Senior Investment Director on our private equity team. New resident to London as of about 5 weeks ago, so very happy to have landed across the pond and be joining Larissa in our London office. So maybe we'll just hit a quick overview of kind of where we are, provide a progress report, and then hit on kind of why we're doing this, why we're here, what's the mission of the London office, and then Larissa will give a quick overview of kind of how we're approaching the investment opportunity set in Europe, as well as ex-US. So a quick progress report on our London office. we're officially here and set up and ready for business. But we completed our registration around the end of last year, and Larissa and other members of our team were over here hard at work to get the office set up and ready to go. So we're in Fitzrovia, which is central London, right in between Mayfair and Soho. So it's a great location, kind of in the locus of where a lot of investment managers and advisors are located. So we're right in the middle of it if folks are coming through London. So we've found an office, and the London team is locked and loaded and on the ground. Next slide, if you don't mind, Dulari. Thank you. All right, we've got everyone's favorite Brit on the presentation here, but yeah, maybe just we can spend a couple minutes on kind of the purpose and the mission of opening this London office. And historically, NEPC has been active globally. We've got investments all over the world, on behalf of our clients. But we really wanted to build our presence, have some on-the-ground investment and research talent to be able to integrate ourselves and more deeply and more kind of in a more robust way into the GP ecosystem and the LP ecosystem in London and across Europe, and kind of build out our networks and be able to source ideas that maybe would not be easily sourced from Boston or from the US. So really, the mission ultimately grow our presence globally, be able to source ideas, be more kind of thematic and thesis driven in Europe and ex-US, and be able to kind of disseminate our findings across our investment team. Obviously Larissa and I are focused on the private markets, but hopefully we'll be able to generate insights which are actionable and helpful across our public market teams as well. So we're well on our way to enhance the networks that NEPC has already built historically, which is manager networks, LP networks, many of our kind of affiliate organizations that we're involved with in the US, and kind of the sister organizations here in Europe, starting to get well involved with those to be able to kind of get more integrated into the ecosystem, promote our brand, and we'll plan to do that through a number of events, both speaking engagements, but also planning to have research leadership and firm leadership periodically coming over to the London office to host events, which hopefully many of you will be able to attend. And then obviously Larissa and I's day job is finding great investment ideas for our clients, and so we're out here pounding the pavement to meet new managers and develop strategies around what's the best way to invest in Europe and ex-US for our clients. So maybe with that we can switch slides, and I'll kick it to Larissa.
Great, thanks Andrew. So I'll talk a little bit about how we're sort of navigating the regional dynamics in Europe, and then also what we're seeing in terms of investment opportunities, sort of the more targeted areas that we're approaching that maybe help you in terms of putting strategies in front of us. So in terms of what we're seeing from an investment landscape perspective, it's really very dominant in Western developed Europe, and that very much incorporates all of the colored pictures, colored countries within this map that we've shown here. Obviously, we're based in London, so UK deal flow is pretty strong, but we're seeing a lot of interest across the region as well. But again, very dominant on that kind of Western side of things. Having said that, this is a really fragmented region, as anyone who's active in these markets understands. That despite efforts from organizations such as the EU, each country kind of has its own ecosystem, it has its own language, it has its own culture, it has its own laws, regulations, etc., which makes it very complex, especially since many of these markets are very mature. Trade and currency dependencies really relates to not only within Europe, but also globally. So all of our perspectives are going to take in a global approach within thinking about how we invest within this region. Especially cognizant is that of countries like the UK that follow very closely Fed policy to a certain degree in order to avoid huge disparities in the currency, but also global trade in general for some of the smaller countries that are less self-sustaining economically. It's a dynamic that we have to always be mindful of. Obviously, macro events have really been a big impact within this region in more recent years, especially. Brexit is still remaining to be a problem for the UK. Many sort of kinks continue to be ironed out. And then COVID impacted the region as it did globally, but again, in this fragmented way where each individual country had a different way of dealing with the pandemic and have different repercussions as a result. Also, geopolitical unrest. It's probably one of the most prominent risks right now. The Russia-Ukraine conflict really impacted especially energy markets and just the sort of fallout of those events and trying to pivot in certain ways has really kind of been a disruptor within the region and may also present some opportunities. In terms of some of the more acute sort of long-term impacts, population decline is obviously a global issue as well. Things such as lower birth rates, aging populations, and migration could really impact some of the labor markets going forward. We think about that often when it comes to things like infrastructure. And then in terms of debt, high sovereign debt similar to the US and other countries, and the bank-controlled lending. There's a roughly 80% control of corporate and commercial lending controlled by banks within the region. It's often a huge opportunity for private lenders to come in when banks are trying to re-establish their balance sheets. So that's something that we constantly monitor. And then obviously, as we're seeing sort of globally, getting used to higher rates for longer and higher inflation that's yet to be totally certain and under control, especially within Europe. So finally, how does that sort of translate in terms of what we're targeting? It's probably no surprise that infrastructure and private equity are an area that we're going to target, with myself and Andrew being here. As I mentioned, energy transitions, there's a lot of support and removal of red tape within this region right now. And then given the Russia-Ukraine conflict, there's a huge effort to pivot towards renewable power. It's a big area of focus for us in this region, and that goes for global funds as well as European dedicated. As similarly within the infrastructure space, a global trend is kind of the increase and improvement of digital communications, as well as the impact of AI on the level of capacity that's going to be required for things like data centers. It's something we're monitoring globally, but we're seeing a lot of activity within this region as well. And then just in terms of that kind of banking dynamic, as I mentioned, we've been active in this region for many years on the private debt side. We're continuing to see some interesting credit opportunities, and our private debt team will be coming over and visiting the London office and meeting with managers and with us as well. And then lastly, pockets of real estate we think could be interesting, having seen some corrections within the asset class and also some differences in the dynamics between the US and sort of the European, especially when it comes to demographics. And again, that sort of fragmented way of thinking about individual regions and how they approach certain markets. So there could be some opportunities within real estate as well. I think the important comment is to say to be continued. So stay tuned. This is obviously a new initiative for us. We will continue to provide updates and we look forward to seeing where this initiative takes us. I will also give some last comments just in terms of best practices before we wrap up this webinar. These are more about how you can engage with us at NEPC. And some of the sort of just to help out in terms of when you are interacting with us and reaching out and talking to our investment team. So in terms of staying on top of our views, what we're seeing, how we're thinking about markets, how we're thinking about investment opportunities, our website, nepc.com, is a great resource. We're very selective, as I'm sure many of you know. So bringing your best ideas forward when you're engaging with us, thinking about quality over quantity is very important so that we can really make sure that we're, providing the best ideas on our side for our clients and sort of sifting through the volume of work that we have. Be prepared to offer competitive pricing. Dulari touched on this. We negotiate fees. We will ask. Please be willing to have those conversations with us. That helps us a lot in our business and the value that we provide for our clients. And then be willing to take no for an answer. We try really hard to provide critical feedback whenever we can. We will have discussions with you if a fund is not something that we're interested, even if it's not at that time. Maintaining that relationship and taking that feedback well, could continue to manage that relationship with us, and sort of maybe we circle back later on down the line. And then lastly, I'll add, we thank you for your patience. We do often have a high volume of inbound. Please be patient with us in terms of getting back to you. We will